Hi, my name's Stuart Weems and welcome to the Investopoly podcast. Our goal is to always share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, today's episode, I was a little surprised that the new tax laws passed last Friday through both houses. Well, through the Senate, which was the sort of final hurdle, I guess. The bill hasn't received royal assent yet, so it's technically not law, but that's just a mere formality. So the bill is the Treasury Amendment Bill, a Treasury Laws Amendment Bill 2026, but it included changes to negative gearing, capital gains tax, self-managed super fund borrowing, and a couple of minor sort of individual tax benefits, which I'll talk about today. So what I might do then is talk about, each of the major changes, negative gearing, CGT, so on, make some commentary about them or share some comments about them. And then next week, what I plan to do is talk about, okay, well, what does this all mean for investing in established residential property? So to what extent does it move the dial? What are the alternatives? And what should investors do? And I'm really specifically speaking about investors that were of a mind to invest in property, existing established residential property before the budget night, either because they haven't already done so or because they expected to continue to build their portfolio. So if you were in that mindset, on budget night, what does that mean for the next couple of years? What should you do in order to navigate this? Of course, if you never anticipated investing in established residential property, then it doesn't really obviously, change your outlook very much. Okay, so let's get into it. Let's talk firstly about the negative gearing quarantining. So essentially, rental losses on established residential property purchased after 7:30 on the 12th of May 2026 will be quarantined from 1 July 2027. So for the 27 financial year, you can still claim negative gearing if you purchased a property after budget night. And the key measure here is the contract date. So that's what's going to drive capital gains tax, is the contract date, not the settlement date. Now, properties that were already owned on budget night, before 7:30 on the 12th of May, are grandfathered. So the previous rules, which means you can claim negative gearing, that doesn't change. So what that means then is for quarantine property, so again, those properties purchased after budget night, from 1 July 2027, it means that any losses attributed to quarantined property cannot be offset against other income. So all it can be offset against is other rental income, residential rental income from both quarantine and non-quarantine property. So for instance, if you had an investor that had, 3 properties that had virtually no debt against them and they were producing a positive cash flow, so taxable income, that investor could go and buy another property and negatively gear against that existing rental income. So let's say that, for instance, their portfolio produced $100,000 of income after all expenses, including interest. If they went and bought another property that was going to lose, let's say, $90,000, well, they could minimize the tax by offsetting. So their net rental income then would be obviously 100 less 90 is $10,000 in that particular year. So, the rules do still advantage people that have built tremendous wealth inside property already and are already generating a lot of cash flow and probably capital gains from that portfolio. So, the whole rhetoric around intergenerational fairness, I'm not really sure about that. But if you don't have any other rental income, you can't offset quarantined losses against salary income or business income or other investment income like you would have been able to do if you owned the property before budget night. Now, what you can do though is offset those quarantine losses. You carry them forward each year and you can offset them against future profits. So if I hold an investment property, it produces a negative cash flow. Typically that negative cash flow is going to be present for or going to persist for 10 to 15 years. Sometimes longer, you probably even say 10 to 20 years. It just depends on how much the rental income grows and what the expenses associated with the property, how they change as well, and also land tax, these sorts of things. So typically, but eventually it will produce a positive cash flow. And so you can carry forward those income losses and then offset them against those future profits. Or if you sell the property, you can offset the carried forward quarantined losses, income losses against the capital gain. So you will get the benefit from them eventually. It's just really the time value of money. And I shouldn't say just really the time value of money, because that is quite significant and we can't underplay it. So, for instance, someone that earns between 135 and 190,000 is in the second highest marginal tax rate of 39%, including Medicare levy. So really for every dollar of loss that they make on their investment property, they get a tax benefit worth 39 cents. So 39 cents out of the dollar is what they get back. If that deduction is delayed for 10 years, the present value of that deduction almost halves to around 21 cents in the dollar. So now my tax benefit is only 21 cents in the dollar. And if it's delayed 15 years, which is probably most realistic, it's only worth 15 cents. So instead of getting a tax benefit worth 39%, I'm really getting a tax benefit worth 15%. And the time value of money here, what I've used is the long-term interest rate, because really if you get a tax benefit, you can put the money in the offset account, you can put it against your home loan. So really the best way to measure the time value of money is the long-term interest rate, which I've used 6.5%. I think as a mortgage, interest-only investment loan mortgage rate is a pretty sort of good benchmark to utilize. So as you can see, quarantining negative gearing is substantially less attractive than obviously getting that negative gearing in the year that it incurs. Now, there's some exceptions to the negative gearing. So new residential property can still claim negative gearing. Vacant land, if you owned it before the budget night, is also grandfathered. And land where construction's already started is also excluded from the quarantining. But really the biggest unresolved issue is what qualifies as new residential dwellings. So what is that definition? The Treasurer has to prepare an instrument, according to the bill, prepare an instrument that sets out that definition. And the Treasurer must be satisfied that the definition genuinely adds to housing supply. So that's what the definition has to hit on. That instrument hasn't been released yet, so we don't know what the answer is. Whether subdividing a property improves it, whether is included, whether adding a granny flat at the back. Of course, something like a new build, buying an apartment off the plan in a large complex, or buying a house and land package, you would think they're going to be within the definition because obviously they're increasing housing supply. But so we'll need some guidance there, and that's up to the Treasurer. That's not inside the legislation. Now, the other thing to be aware of is that the resetting of acquisition date. So the bill treats any joint tenancies as tenants in common. So joint tenancies is typically how most people own their home. Where you have joint tenants, there's no divisible ownership percentage. It's just 2 people own this property or 3 people own this property. In the tax legislation, typically it's assumed that they own it in equal parts. But with joint tenancy, if one person passes away, the ownership automatically transfers to the remaining joint tenant, whereas if tenants in common, the ownership percentage goes into their estate. So what the legislation does is treat joint tenancies as tenants in common. So it'll be assumed that the joint tenants have equal share of the property. And so if one owner comes off the title, either because they've passed away or there's a relationship breakdown, the remaining owner or owners are treated as acquiring a new interest in that property. And so that new interest in the property means that they will no longer be able to negatively gear it. So that's how the bill has been approved. I know there's a bit of negative rhetoric about this. If you go through a marital separation and, you want to keep the property, when one partner wants to keep the property and rent it out, in that situation, they won't get negative gearing on 50%. Let's say they're joint owners. That's not ideal. Similarly, if one spouse passes away and then you, in the future, want to rent that property out, only 50% of the interest would be deductible, and negative gearing is allowed on only 50% of the property. So there are a couple of, I guess, unfair consequences of the law, but that's how at least the law stands at this stage. Again, it hasn't got royal assent, but that's a mere formality. Now, look, I like to remain, I've said this a lot of times and I'll keep saying it. I want to be apolitical in this podcast. I don't want this to turn into, some sort of, way of beating some particular drum in a particular political direction. That's not it at all. But every opening of this podcast is about evidence-based strategies. So let's look at the facts and the evidence. And the government saying these negative gearing changes are designed to help more Australians own a home and to really address intergenerational inequality. But there is no credible evidence that quarantining negative gearing will achieve either of those objectives. I'll say that again. There is no credible evidence. So even Treasury's own modelling around this estimates that property prices may fall by only around 2%. And that modelling is broadly consistent with other work by economists that economists have done over the years. So there's not just related to these changes, but over the years there's been a lot of academic research around to what extent do tax settings impact housing prices. And the overwhelming conclusion for most of these studies, and some of them are independent, some of them aren't so independent, but the overwhelming conclusion, is that tax settings impact housing prices at the margins. So they do have an impact, but the impact is not material. And of course, there's other factors that impact housing prices to a greater extent: ability to borrowing, access to the market, housing supply, these sorts of population growth. These other elements are far more impactful. And we've seen this movie before, right? So negative gearing was quarantined in Australia between 1985 and 1997. And there was no material improvement in housing affordability rates. And even rents didn't change that much. They did in Sydney, but, and this is the thing, right? There will be impacts in certain geographical markets, or for certain property segments are going to be impacted more than others. So to say that rents are never going to change, that's not true. But at a macro level, so at an overall level, it's unlikely that prices and rents will change. We can look at New Zealand's experience of essentially quarantining negative gearing or limiting interest deductions between 2021 and 2025. Same result, no material change in housing ownership. UK phased out full interest deductibility from 2018, and that was fully in place. It was phased fully in place by 2021. And again, home ownership rates have not materially improved in the UK either. So we've seen economists' work, and we can point to a few other relatively comparable regions that have done this previously, and it hasn't changed. It hasn't moved the dial. So let's be honest about this, that these changes are tax revenue measures. They're not anything to do with housing affordability or intergenerational equality. So again, it's not my opinion, just citing the evidence, because, the thing is, right, you would think, okay, well, if we're going to have fewer investors in established property, you would think, okay, there's less other buyers to compete with, that's got to help. And then you would also think logically, well, then rents are going to rise. But actually, neither of those things are true. So in reality, neither of those things are true. Rents didn't rise very much. Rents have risen a little bit in the UK, but the rental market's super tight. Like, I think I looked at some stats in last year that for every vacant property in the UK, there were at least 20 applicants or something like that. So it's super tight, but it doesn't necessarily translate to rental increases. And that probably makes sense, because it's not like renters can pay more, so it's not like renters can pay 50% more. They're constrained by their income. And so it kind of makes sense that, that the rental elasticity in terms of prices, it's probably relatively elastic, because renters don't have the capacity to pay more, but it does create a very tight market. So we probably don't see much change in prices, much change in sort of rental incomes, but it also doesn't impact, so the policy doesn't do what it sort of says on the tin. Again, it's just political rhetoric, I think. Okay, so that's the negative gearing part of the legislation. Let's talk about the capital gains tax. So from 1 July 2027, again, the 50% CGT discount will be repealed, and for individuals and trust, the cost-based indexation method will be used. So essentially, the cost base at 1 July, so there'll be a deemed disposal and acquisition. So really the market value of all assets, property, shares, whatever you've got, paintings, jewelry, the market value will be the new cost base, and that cost base will be indexed to CPI, to inflation. So essentially a line at 1 July 27, a line in the sand will be drawn. Any assets that were owned before that time, the difference between the cost base and the market value will be calculated using the 50% method, 50% discount method, and then post 1 July 27, we'll be indexing the market value of the asset and then measuring the difference between the market value and the net sale proceeds when that asset's eventually sold. And so there'll be sort of two periods that we'll need to, part A and part B, if you like, and then together we'll be able to work out, what is the capital gain, and we'll be using that approach after 1 July 2027. In terms of market valuations, the ATO, well, I expect the ATO is probably going to update their guidance around this, but normally there's certain levels of evidence that the ATO will look at, and the type of evidence you might get will depend, I think, probably on the value of the asset and how easy it is to defend each different level of evidence. So the one that has the highest level of evidence would be a sworn valuation. Next would be, if we're going to talk about property, for example, it's because it's probably a common one. The next one would be some letters from a real estate agent. So you might get 2 or 3 letters from a real estate agent to say, we think this property's worth X, and we've used these 4 comparable sales to determine that value. So that'd be the second highest level of evidence. And the third would just be your own research as a taxpayer. So again, you could do the same thing and say, well, here's all the comparable sales. Here's what I've relied upon. Here's how I've determined my value. And the level of which you use will depend, I think, on your compliance risk and the amount of money that's involved. So, but I'd imagine the ATO is going to give us some guidance on this. So it's not like everyone needs to go out and pay for a sworn valuation. You might not do that. It just depends on future guidance, but that's typically what the ATO will look at. Okay, I want to share sort of 4 highlights, or highlight 4 important points regarding these CGT changes. The first one is that indexation isn't retrospective, so it only starts from 1 July 27. If we've benefited from the 50% CGT discount for assets that were already owned before 1 July 2027, then that's okay. We can still benefit from that. So it's only changing the tax we'll pay on future gains, not gains that we've already enjoyed or generated. The second one is a really interesting one, that indexation can only reduce your gain to nil, but it cannot create a capital loss. A capital loss only arises where there's a nominal or actual loss. So that is that you sell an asset for less than what it costs you to purchase. And let's just keep it clean. Let's assume this asset was purchased after 1 July 27. So in the new sort of system, let's say you purchased an asset for $100 and you sold it 10 years later for $120. The index cost base, let's say the index cost base, because you bought $100 10 years ago, and according to CPI, the index cost base is now $130, and you sold it for $120. So the index cost base is higher than the net sale proceeds. In that situation, you would say the gain is 0 because indexation can't create a loss. So, but the fair way to do it would be to say you've got a $10 loss, right? Because now your cost base is 130. You haven't performed at inflation. So in real terms, you've lost money, which is true, right? But in nominal terms, you bought the asset for $100, sold it for 120. So there is a nominal gain, but if you add indexation, you're at a loss. Bad luck. It's nil capital gain in that scenario. The only way you can crystallize a capital loss under this new system is if you sell it for less. So if I buy the asset for $100 and 10 years time I sell it for 90, I can claim a $10 loss, a carry forward a $10 capital loss, but I don't get indexation. So it's asymmetrical there, and it's unfair because I'm indexing gains, but I'm not allowed to index losses. So a little bit unfair in the legislation there. The other really interesting one is for non-residents. So if you become a non-resident, a non-Australian tax resident during the period of ownership, there's some negative consequences. Now, if you're a non-tax resident, you're genuinely, or generally, I should say, not taxed on any assets other than what they call Australian taxable property, which is really residential property. So let's just talk about property here. So if I go and buy a property today, I own it for 10 years, a 10-year period, but during that 10-year period, I was a non-tax resident for, I don't know, a year, let's just say. Well, the legislation says that if I'm a non-tax resident for even only 1 day during the ownership period, I don't get any indexation. So the indexation for the whole ownership period disappears. which is, insane. It's completely unfair. And finally, the other unfair part of this legislation is that pre-CGT assets, so those are assets purchased before 20th September 1985 and now brought into the CGT regime. So they're deemed disposed and acquired on 1 July 2027. So just like every other asset base, their cost base becomes market value at that time. So any gains incurred or enjoyed between 20 September 85 and 1 July 27, they're not taxable. Okay, so that's fine. But now they're going to tax pre-CGT assets. That's never been done before. So you can see that's quite aggressive legislation and not particularly fair, I don't think. So the new regime doesn't apply, the new indexation regime doesn't apply for all assets. For new build property, new residential dwellings and affordable housing, owners of those types of assets can choose between either the 50% discount or the indexation regime. But apart from new build property, affordable housing, everything is going to indexation. There's also a new minimum tax rate of tax. Now, this is only going to apply if your other ordinary income is below $45,000. And this is the thing that doesn't make sense to me, because low income earners are really going to hurt here. So, but if you have other income, whether that's investment income when you're retired or salary and wage income that's more than $45,000 a year, you don't really need to worry about this minimum 30% CGT rate. So I think probably most of the people listening to this podcast won't be impacted. But from 1 July 2027, a minimum 30% CGT rate will be enacted. And the only thing you can do to offset that, because normally you used to be able to, if you incurred a capital gain, we would say to people, okay, make as many super contributions as you can and maybe even use some carry forward if you've got availability to that. And that will then reduce your taxable income, which will reduce the tax that you end up paying on the gain. You can't do that with the new minimum tax. So the capital gain is a separate calculation to the tax on your ordinary income. And the only thing you can do to reduce a capital gain is by making donations, charitable donations. So I just answered a question on the Australians podcast. So James Kirby and I did a Q&A on these rules. So if you're listening to this podcast, the Money Puzzle, the Australians Money Puzzle podcast comes out typically on a Wednesday, not early on a Wednesday morning, but usually mid-morning or something like that. So if you want to check out that podcast, I answered a lot of questions there, listener questions, and they're kind of interesting. I answered one for a self-funded retiree that had $15,000 of investment income and made a $10,000 capital gain. Essentially, that investor would have, under the previous rules, would have paid $250 of tax in that particular year. Under the new rules, they pay $2,300. So a ninefold increase to someone that I would argue is kind of Labor's supporter base, which is, someone that's not necessarily on a very high income and they're paying a lot more tax. So if you've got a lot of income, no big deal. This isn't going to bite. But if you're a low income earner, it's going to hurt. Doesn't really make a lot of sense. And flat tax rates are stupid, right? Because you create these situations where people that might not be able to afford it end up paying a lot more tax. Now, let's just talk about the old 50% discount system and the new indexation system for a second, because it's good to consider, is one better or worse? And it's not a hard and fast rule. It really depends on how long you've owned the asset for and what the performance of the asset is. And so I've got a table on the blog, and of course the link is in the show notes. And what the table does is it shows the break-even capital growth rate point. So this is, if the growth rate is below this benchmark, then the indexation is better. If the growth exceeds this benchmark, then the indexation is worse off. And so, for example, if you own an asset for 5 years, and this is assuming CPI is 3%, which I think is a reasonable assumption. If you own the asset for 5 years and the capital growth rate is above 7.5%, the indexation system will mean you'll pay more tax. But if it's below 5.7%, it means the indexation system actually will create a lower taxation liability for you. Over 20 years, it's 4.9%. So again, if you own a property and the growth is less than 5%, around 5% over the 20-year period on average, well, then you're actually going to be better off under indexation. So indexation will benefit people that make investment mistakes, which, I mean, it's not so bad, right? If you make an investment mistake, let's not compound it with additional tax liabilities. So there is some good news here for those people that buy an asset and the asset doesn't perform as they would hope. But if you buy an asset and it performs very, very well, then of course you're going to end up probably paying more capital gains tax. But that kind of makes sense. You know, if you've made a lot of money, then you can afford to pay a little bit more tax, much like how the income tax system works. But if you've bought an asset and held on for it 30 years and its performance has been pretty poor, then it's okay. You probably shouldn't have to pay too much tax. So in that regard, the indexation system does work better than the flat discount, the 50% discount system. The next point I wanted to talk about was the minimum tax rate. I actually should have mentioned it just previously, is that it means that if you've got some assets in your personal name, you might want to think about whether you want to crystallise a capital gain in the 27 financial year when there's firstly, when you can take advantage of the 50% discount, so you don't have to use the indexation regime yet, and there's no minimum rate of CGT. So, for example, if I'm a self-funded retiree, I don't have much in the way of taxable income because I'm really drawing money from super, and I had $20,000 of shares that had some unrealised gains in them, I might be better off selling those shares in the 27 financial year rather than hanging on to them in the future and then being caught by this minimum 30% rate. So just something to think about from that perspective. I'm sure I'll be writing more about these sorts of strategies as we become more used to these rules. And the final thing that I got two more points in regards to capital gains tax changes. I think business owners are probably hit the hardest here from these changes because replacing the 50% discount with indexation impacts business owners typically the most, because if they start a business, their cost base is almost always zero, unless they go and buy a business, but if they start it from scratch, their cost base is zero. So indexing zero is still zero. What that means then, if I start a business and I sell it for $2 million 10 years later, my cost base is zero, index cost base is zero. So my gain is $2 million and I've got to declare a $2 million gain in that year. I might end up paying just slightly less than $1 million of tax. So 50% of my gain is paid in tax. So the government's promised, it hasn't legislated this yet, but it's promised to increase the turnover threshold from $2 to $10 million so that small businesses can access the 50% active asset reduction, not the other parts of the small business CGT concessions. So they still can't access the 15-year exemption or the retirement exemption. These laws are a bit complex, so we don't need to dive into them at this point in time. But it means that then if they do enact those laws, if they do change those laws, it means if I sell my business for $2 million and the turnover is less than 10, at least I'll get one CGT discount. So therefore, I'll be declaring $1 million gain and I'll probably pay $500,000. It's still not as good as the old system, which I could, use a couple of different mechanisms to reduce the capital gain and then make a super contribution and potentially pay no tax. That was the old system, and it was a good system because what it meant is that people that started a small business, worked in that small business for many years, didn't really contribute to super, their business was their nest egg, they were able to sell that business and keep most of the proceeds to fund retirement. Of course, the more you tax people, the more they're going to be dependent on the welfare system. Of course, you want more independent retirees in Australia than fewer. So the changes announced to the small business CGT concessions are positive, are more positive than not changing, but it's still really negative for small business. It's just yet another reason not to start a small business. And, small business is really the lifeblood of the Australian economy. So I think the argument for every political party should be to grow the pie and keep the percentage tax the same. So if you want more tax revenue, grow the economy, grow the economic pie. Don't shrink the economic pie and then increase tax rates. That's just a dumb way of doing things. So not particularly aimed at Labor, but really any political party. So I think these CGT changes, not great for investors, but really quite terrible for small business. And the final comment I wanted to make about the capital gains tax changes was, a lot of people are asking about, well, if it's all about housing affordability, why are we increasing capital gains tax on shares? Why shouldn't those capital gains tax increases only just apply to property? And the government's argument around that, as far as I could tell, has been that what we're trying to do is bring the taxation of capital gains more in line with how income is taxed. And so the minimum 30% tax rate, for example, sort of in line with the minimum tax rate on income earned, on labour income. But that argument's deeply flawed because capital is far more mobile than labour. Governments can tend to increase income taxes and it doesn't really cause the same level of distortion because people rarely just go, well, I'm going to leave Australia because now I'm going to pay 2% more tax or 10% more tax on my income. Certainly some people are thinking like that, but for most part, the reason why you're living in Australia is many reasons, family and children, and Australia's a great place to live. So, the labour mobility is less elastic to taxation changes, whereas capital is completely mobile, which means that, if you're going to tax me too much as a individual, economic theory is that I will save less. But if there's some tax benefits associated with saving, like super is, for example, it's a great example, then I'm going to save more. Super not so much because it's a mandated saving, but still people proactively make additional contributions into super, so it's still a reasonable example. The other thing too is if the taxation settings are too high, overseas capital won't come to Australia either. So the reality is that you should tax capital differently to labour income. And the fact that the government is saying, no, we're just making these things equal, kind of suggests that they just don't understand the mechanics, the basic economics of it. And notwithstanding this, why does increasing CGT on shares and businesses help housing affordability? Well, it doesn't. And I think all it does, again, as I said at the beginning, all it does is show that these are not measures to help housing affordability. These are measures to raise additional tax revenue to fund additional spending. Okay, would you like some good news? Yes, so would I. I don't have any, but there's some slightly mildly positive news. So in the legislation was a 250 working Australians tax offset. So they'll reduce the amount of tax you pay by a whopping $250,000. Doesn't happen immediately, happens in the 28 financial year. So of course you need to have some labour income in your tax return to benefit from that. So it's not going to benefit self-funded retirees. So that's a $250 in your pocket, big deal. The other part in the legislation was for this financial year, 27 financial year, was a $1,000 instant deduction for workers. So instead of having to substantiate work-related expenses, you can now claim $1,000 without any substantiation. It only relates to work-related expenses. So if you still have deductions like income protection insurance premiums, union fees, professional association fees, all those sorts of things, those claims separately outside of that $1,000 limit. So that's the only good news I have for you. As I said, it's probably incorrect to frame it as good news. And the final thing in the bill was the banning of self-managed super fund lending. Of course, that's what the Greens wanted, and that's what Labor had to concede in order to get the bill through the Senate. So it means that self-managed super funds can no longer borrow to buy residential property. They can still do it to buy commercial property. The ban becomes effective 45 days after the bill gets royal assent. So that's probably around mid-August. So anyone that has purchased, anyone inside a super fund, so if a super fund has purchased a property but hasn't settled yet, and the contract date is before around mid-August, that date's still yet to be determined, then it'll be fine. That person, that super fund can proceed with the purchase. But after that date, they cannot buy a property and then borrow to fund that acquisition. Now, on one hand, it's not good news because, that was a wealth accumulation strategy that could work in some circumstances. So you would say, the previous generation, or at least people between 2007 and 2026, were able to utilize that. So in a way, it creates, a disadvantage for anyone that hasn't utilized it. On the other hand, the flip side to this is that because negative gearing on established property was quarantined, but it didn't apply to super funds, that quarantining. So what would have happened if this wasn't banned is there would have been a lot of property spruikers, I think, cajoling people to set up their own self-managed super fund so they could borrow to invest in established property. And I think a lot of people would have done that and got bullied into doing that, or using hard selling tactics, all these sorts of things, ended up with very average property in their super fund. And, you can't expect great returns from an average quality property. So I think at least that risk is removed now. And I don't think that's such a bad thing. I think the attractiveness to negatively gearing property inside super isn't that attractive. And especially if you're not investing in a very high quality property. And I think a lot of unsuspecting people would have been sold really average quality property. So yes, it's negative because it closes the door on that opportunity. But from an Australian community perspective, I actually think it's not so bad, because at least spruikers, it closes the door on one additional way for spruikers to, sell crap property to people. Okay, the other key part in the federal budget in May was the taxation of discretionary trusts and applying a minimum 30% rate there. They haven't drafted that legislation yet, so it wasn't included in this bill. As I said in May, I think that of all the proposed changes, that one is the most contentious, and I think they're probably agree with me in that regard, being by leaving it out of the bill. So let's see what happens there. But of course, I'll talk about that on this podcast if and when it happens. Next week, as I said, I want to talk about how these tax changes affect the case for borrowing to invest in established property, and whether alternatives such as commercial property and newly constructed property are likely suitable substitutes. So until then, I'll leave it there. And until then, bye for now. Before I go, my new book, Wealth by Design, is now available for pre-order. Pre-orders matter more than you think. They're used by bookstores and online retailers to decide how many copies of the book to stock. So, as a huge favour to me, if you're considering buying the book, I'd really appreciate it if you pre-ordered it now rather than wait. And the part that I'm most excited about isn't really the book itself, it's the AI companion tool that I've built to go with it. I reckon it's a game changer, and I'd love you to see why. The pre-order links are in the show notes. Thanks a lot.